he has some very interesting things to talk to us about today. So, Joe.
Okay.
You have it?
Thank you, Mark.
Yes.
Okay.
So let me.
Is that going to work for me to film it with that little light on?
I think so.
How about me? Okay. Okay, Mark, thank you very much. Thank you very much for the opportunity to be here. I'm the director of the Kettle Pond Institute, and so, you know, with the full disclosure, some of that full disclosure stuff would require me to say that Kettle Pond Institute is fewer people than is in this room. It's about a little bit more than the people in the back row. So it's a tiny research, public policy research, you know, undertaking that happens in Vermont, and I'm happen to be the guy who they push out there, because the full name of the institute is the Kettle Pond Institute for Debt-Free Money. And eventually, if we stayed talking long enough, I would get to the point of the debt-free money. But for today, I'm going to get to it strictly in the terms of the public money constructs that are out there and that have been out there for actually a couple of hundred years. You know, the colonies here in Virginia were one of those who had their own, you know, debt-free money system. All of the colonies had debt-free money systems. So it's an old tradition in terms of innovation in money.
Please close the door.
I came to Mark's introduction through Dr. Nick Tiedemann, who also teaches here. And Dr. Tiedemann is often a lecturer at the American Monetary Institute's annual conferences, which are conferences that actually promote the idea of reform to the money system. And Dr. Nick, I've been speaking there every year since they opened, and I started speaking there something I think in about 2008 or 9. And so I've known Nick over the years, and I've said to Nick, you know, that you know, I would really like to have an opportunity to sit down and have a discussion with the young people that are out there learning about economics today in terms of this concept of debt-free money. And so I gave a talk last year about the second part of what I'm going to talk about today, which is Dr. Hyman Minsky in his research paper. And Nick said, "Hey Joe, that was a really good one, you know." And so I asked him again. I said, "Nick, how about if I could come over to Virginia Tech?" Because I live down on the eastern shore of Virginia, even though I'm the director of this institute in Vermont. I lived there for 25 years, but about 15 years ago, we moved down to the eastern shore of Virginia. So I said that maybe I could come up, and then he wrote to me and he said, "Joe, I think you're going to be better off talking to Dr. Mark Liu's money and banking classes." So this is the way I approach things. Not only do I not have a degree in money and banking, okay, or money or banking or economics or anything, okay. I'm a high school graduate myself, and everything that I learned about money, I learned from my dad, who took up the study of money himself, his own personal independent research of the study of the monetary system. And I want to be specific about that. You guys study money and banking, but we look at it as the monetary system in itself. Banking is associated, and especially since we have a money and banking system that can't be separated. Money and banking is what the kind of the school of idea is, but for us, it's the monetary system that's important, and the banking system is something that's about extending credit, creditworthiness, and those kind of things that bankers look at. But the monetary system itself has to be understood. It was what Franklin, you know, explained to the British on his visit over there. They said, We don't understand how you colonies actually run your government and your commerce. We have all kinds of problems that are always coming up because they had fractional reserve banking for about a couple hundred years, or 150 years by that time. And Franklin said, you know, we issue the money in the right quantity that the economy needs it, and it's neither inflationary nor deflationary. So in other words, it is doable. It is doable. Issuing the money without deflation or inflation is doable, eminently doable, and that's provable. But we don't have that today, do we? In fact, what we really have today is a crisis in the monetary and banking system because they're joined. So if there's a crisis in if there's an apparent crisis in finance, let's say 2008, then there's a crisis in the monetary system, there's a crisis in the economy. So like I said, everything that I really learned, I learned from my dad, who had to drop out of school in the 8th grade in the 1920s because his father was injured in a construction accident, and the family couldn't do without the income that my grandpa would have been providing, so they told my dad, who was in 8th grade, 14 years old, sorry, you're going to have to get out of school and go to work. And he did. Today's his birthday. So I couldn't be happier than to be here on his birthday to be talking to you guys about the subject. I want to tell you that, first of all, it didn't go well for my dad to try to teach me about money. You know, I'm a progressive. My politics are progressive. They've been progressive ever since I was a kid, I guess. And my dad's politics were conservative, you know, Republican, even libertarian. He actually learned about the money system starting with the libertarian school, the Austrian school, because those are the only ones that were really talking about money. And then eventually, in terms of the number of years, they moved on. How I'm going to try it. This is how I was going to try to talk about this today in 3 sections. First, a perspective, a very unique perspective from Dr. William White, who was the head of the Bank for International Settlements Monetary and Economic Policy Office of Monetary and Economic Policy. A distinguished gentleman, strictly not just so much for what he knows, but for his candor, as you'll see. Then the second was the problem of money and banking. Now, I don't know if everybody got the links. I think Dr. Liu sent them, which was just an article that I wrote for Global Economic Intersection about, well, it was about the same time that Dr. White did his interview with the Cogden Center. And then the last part of it is the problem of banking and capitalism, and I should have said the problem of banking and of capitalism itself, okay? Which is Dr. Hyman Minsky's working paper number 127 from the Levy Economics Institute, which he titled, as it says, Financial Instability and the Decline, with that question mark in parentheses that's on the face page of his document, of banking and the public policy implications of the decline of banking. And to me, the reason that he put the question mark in there is very simple. Because people would think that it's the decline of banking, but really, monetary reform is not the decline of banking at all. In fact, it will be the most freeing of policy changes that they could be for the banking industry itself. So having said that, if I do this right, okay, so Dr. William White, the former director of the BIS, he was interviewed by the Cogden Center, and the Cogden Center is another independent, libertarian perspective, Austrian perspective on money and banking from the UK. Okay, so they have a big reading there, like the Hayek Cafe or the Minsky's blog here. So they interviewed him, and this is cheating for all you guys, but it's allowed for me, okay? I'm just going to give you a whole bunch of quotes from two outstanding people, to try to convey the situation of where we're at today. And one of them is Dr. William White. And this is how the interview started. The first question was, what about QE for the ECB? I know I shouldn't do that, but we all know quantitative easing is. And we should all know that the ECB is the European Central Bank. So they're from Europe, and they said, what do you think about the European Central Bank taking on doing quantitative easing just like the Americans have done? And this is his answer. And this is his answer only in there for a very specific point. He said, I remain worried that its implementation might bring with it unintended and undesirable consequences for the ECB to do that. They already have, in case you don't know what the sovereign debt situation is in Europe right now. All that said, I think the ECB was under such pressure to act further that it had little choice but to do what it did. Now, that, to me, like as a policy guy, I say to myself, well, somewhere there's people running around saying, you know what, everybody's saying we got to do something, so we can't just stand here. And that to me is how I would convey that. That in itself, I think, is really unfortunate because it drags another important central bank still deeper and deeper into the malaise of central bank overextension. Does everybody know what that means? I sort of assume that everybody knows what that means. The malaise of central bank overextension. Okay. Central bank accommodating too much credit being issued by the banks so that we have a bubble that is created. So then he observes, it's mad here and it's mad everywhere. It's more of what got us into the trouble to be in the first place. So the guys from the Cognitive Centers, their first question, QE for the ECB. He says, I think that's a problem. Then he goes to this. Some of these slides are telling, and some of them are just informative. Now this one here is telling for a different reason. He says, I'm working on a piece for the G30 which basically deals with the future of central banking and the future of monetary policy. This is what he said. So the group of 30. Did he say no, I'm sorry, he didn't say the group of 30. He said the G30. Now sometimes the G30 people think the group of 7 or the group of 20. Which are nations that are involved in monetary and banking and commercial consort. But the group of 30, I'm sure you all know, is the vocal group of 30, is the group of 30 prestigious central banking economists and leaders of the central banks. In fact, right now there are 2 former general managers of the Bank for International Settlement that sit on that. And that's really, one of the most prestigious in the world. He says, I'm working on that. Now, what does he say? I sense from talking to many of the members of the Group of 30, many of whom are previous central bankers, that they're very concerned about the direction this has taken. What does he mean this has taken? The direction that the central banking methodology and where it has brought us, in particular the continued over-reliance again on stimulative monetary policy to get us out of the predicament we're in. Clearly they are really, really worried about it, and I don't blame them. Now, I've just told you that the most prestigious group of monetary economists and central bankers in the world are worried about the situation that they find themselves in. And I hope that don't scare you out of getting out of money in banking, because it shouldn't, okay? But it should have a little light going on. Clearly, they are really, really worried about it, and I don't blame them. That's a quote from him observing on the G30. Okay, I think increasingly they, the central bankers, are discomforted more than anything else. I think it's not just the ex-central bankers, but increasingly the people that are still holding the levers. And that's kind of a funny thing for him to say, because to me, there are no levers, and that's their problem. Once you take monetary policy and you take interest rates down to 0, and the economy's still not happening, what levers do you have? What's the monetary transmission vehicle in this private fractional reserve banking system, central banking system, that we all live by in the world today? And that's why public money is the answer. He says, they're starting to ask whether they've been somehow backed into a place where they really don't want to be. They're starting to ask if they've been backed into a place where they really want to be. Something's wrong. But I rather sense that an increasingly large number of central banks are actually looking at what's going on and saying, we're being asked to do something that is effectively impossible. Now again, if the fact that the central bankers of the world are saying that they're being forced to do something that is essentially impossible, then we should be looking at doing it some other way. That's my take on it, because I'm from the Kettle Institute for Debt-Free Money, okay? Now this to me is one of the more telling quotes from Dr. White. He says, in a nutshell, most central bankers know that our economies do not face a liquidity problem, but a solvency problem linked to excessive debt accumulation. He says, if it's a solvency problem, central banks can't fix it. Okay? You guys get that? If in fact it's a solvency problem, central banks can't fix it because what can they do? It's a solvency problem. What are they going to do about the solvency? Well, that's why we need a new monetary system. Now, he didn't say that, by the way. Dr. Bill White would never say that, but I just said that was just my opinion coming out of there. The only way they can fix it is by inflation, which with the debt levels that were being what they are, could very quickly get out of hand. So that to me is a significant point of discussion. If it's a solvency problem, central banks can't fix it. And yet, if there's a solvency problem within the banking and monetary system, the politicians are going to turn to the central bankers. And they're going to say, well, come on, you know, either give us some more quantitative easing or whatever. And then again, remember, this is Dr. White. He says there's a great line from J. Kent Galbraith that I used in a paper a while back. You remember Rad Butler. I don't know if you guys know who he is, but he was the Chancellor of the Exchequer under whose autobiography was called Politics, the Art of the Possible. He said, Galbraith denies this, saying, politics is not the art of the possible, it is choosing between the unpalatable and the disastrous. That is where we're at. That was Dr. Bill White, the head of the Bank for International Settlements, the central bankers, Office of Central Banking, saying that's where we're at, between a rock and a hard place. Does it matter? I don't. Does it matter? We'll see. Again, I'm still here, Dr. White. I think increasingly they are discomforted. Oh, wait a minute. Did I go backwards? Yes, I did.
No, you're right.
I was right.
You scroll up and down, use the arrow
Okay,
key.
okay, let's see. Okay, that's wrong. I think in order discomforted. Okay, I'm sorry. This is not my really long suit. Okay. Now here's his observation. It's notable that in the course of the last couple of years, the BIS in its annual reports has repeatedly used the term debt trap. Debt trap. That's what we're in. That's the thing that's keeping us from actually prospering anymore. He says, very low interest rates encourage so much debt increase that the central banks fear raising them again because that'll bankrupt everybody. That's the debt trap. There's something going on here with this dynamic process that is being increasingly recognized as dangerous. Okay? That's language coming out of a central banker. Central banker should give people pause. But I put that asterisk there. He said, that's the debt trap. And I put, really? Is that the debt trap? Or is that how the central bankers look at the debt trap, rather than the people who are in the debt trap? And to me, he didn't quite get that right, quite frankly. He says Olivia Blanchard, who was the chief economist for the IMF at the time, has come out on 2 occasions recommending higher inflation as a preventive measure for future crises. His logic is that if you had higher inflation, that you'd have higher nominal interest rates associated. And if you had higher nominal rates, then when you get into one of these crises, you'd have more time to maneuver by lowering nominal rates. So let's jack the rates up so that we can lower them when they start to do something. My initial reaction and that of many central bankers was very negative. Where do you think the higher inflation is going to come from without the kind of monetary and credit easing that's going to create even more problems than we've got already? So for those of us who look at it this way, okay, we are in a debt overhang, debt saturation, debt trap world of a whole. We have too much debt and not enough money. And the solution from Olivier Blanchard was to give him a shovel. As I said before, I sense a growing sense of unease about where this will all end up. I find it extraordinary that some economists still do not recognize that we have a fiat money system. Banks do not lend money that has been saved. Is that clear? Now, all of my questions are rhetorical, by the way. And I was going to say that there would be no test on anything that I say, but Dr. Liu said, maybe. So you're warned. So, but he says, banks do not lend money that has been saved. They create money by making loans and simply writing up both sides of their balance sheet. This system can also get badly out of control, as we have seen. There's really an issue here. Okay, now this is where the public money part of it comes in. I don't know how many of you are familiar with the fact that after the 1929 crash happened, that the Chicago school economists, led by Dr. Henry Simons, proposed to FDR that we bring in a new monetary system, okay? A public monetary system, publicly owned, publicly issued monetary system, issued without debt, like I'm talking about, okay? So this is, again, Dr. White's words. Do we want to go back to 100% reserve banking? And I'm very glad, or something of that nature, because we don't have to go back to 100% reserve banking, just so you know, we don't have to, okay? He says, and as suggested by the Chicago School and Irving Fisher in the 1930s, and Irving Fisher's proposals at that time actually were for full reserve banking. Well, I've not thought enough about it to say where I'd come out of the debate. It certainly is an issue that we should be thinking about. He's saying the public money solutions that were proposed by the Chicago School economists in the 1930s to FDR to resolve the money and banking crisis we have then, we should be something that we should be thinking about. And I was a little perplexed. I was a little disturbed that he said, I haven't thought about it enough to think of where I come out in the debate. I'm sorry. What else did he have to think about? Really? It seems to me he should have been thinking about it every day. He says, now that public money thing, stop the banks from creating money when they issue loans. Don't stop them from lending, just stop them from creating money. Disassociate the monetary system from the banking system, okay? He said, this has also been suggested recently by Martin Wolf. He had the famous headline, stop the banks from creating the money. There are serious people whose suggestions should be treated equally seriously, and in a similar vein, I repeat what I said a few moments ago. We also need to go back, he says, to look at the whole international monetary system, or non-system, as I and others have called it. So that's the end of Dr. William White's, my quotes from Dr. William White's interview, and I'm pretty sure that, again, that Dr. Liu provided everybody with a link to that interview at the Cobb Center from their website. And I invite you to try to find in there any countervailing opinions than the ones that I have cherry-picked to provide to you guys today. Okay, so that's the end of Dr. White's interview section. And now I'm going to move completely over, and I'm going to admit that I did this backwards, and I apologize for that when somebody's thinking about those kind of things, because Dr. Minsky's paper was written in October of 1994. Okay, and Dr. White's interview was in, I think, 2015, I'm pretty sure, 2014 or 15. Okay, so after the last financial crisis, but this all preceded the financial crisis. Dr. Hyman Minsky is a renowned research economist. He formerly taught at Brown University and Berkeley, which are both, not only fine economics but financial schools. And then he taught at Washington University for 30 years, and he retired from Washington University as a distinguished professor. And he went on to the Jerome Levy Institute at Bard, where he became just a research economist, just so that he could focus on research. And in doing that, he published many papers. And this is where I have to admit, I didn't find Dr. Minsky's working paper from 1994 until 4 years ago. Okay? I was scrolling through the list of his research papers at the Levy Institute, and I saw this one. And I honestly didn't say anything about it for a year because I was digesting what I was reading and trying to put it in place in terms of what everything I was thinking about and knowing. And then I started to say, wait a second. Dr. Minsky has provided, an incredible piece of political economy that is pertinent to everything that's going on in the world today, and he did it in 1994. And so to me, that was something that was remarkable. Now, my dad associated in some ways with Dr. Minsky, okay? When my dad was doing his research in the 60s and the 70s and the 80s, and he consorted with Dr. Minsky, because Dr. Minsky was a consultant to the Commission on Money, and Credit that took place, and because of that, my dad was trying to get him to think like he was thinking, but Minsky didn't go that far. But that was in the 70s. But in the 1990s, what I'm going to tell you is he went that far, and this paper is where he went that far, and I was very glad to find it. So that's the title of it. Financial Instability and the Decline of Banking and Public Policy Implications. How does he start off this research paper? That's the number one line from page 1. The definition of the problem. Well, shouldn't we? Banking plays two roles in a modern capitalist economy. It supplies the means of payment and it channels resources into the capital development of the economy. Everybody understands that, right? I mean, there's no question but that is the truth, right? I mean, in the money and banking system that we have today, the banks create the money, and then they say where the money goes. They determine where it is lent. They determine, what's the most profitable way for them to do it, et cetera, et cetera. So they determine the capital development of the national economy by the power they have to create the money, okay? Now, being that I'm a progressive, I will tell you that, and being that, by the way, Dr. Minsky, in 1994, being a distinguished research economist, wanted to keep writing papers. So he writes papers like as if, he's a research economist. I would have started that completely differently. I would have started out in a modern capitalist economy, the banking plays two roles. It supplies the means of payment. Why? Why? Because that's the issue that we're going to get to. We're going to get to how capitalism works or doesn't work, and what's the cause of it, and what we can do about it. But that's how we started it out. Banking plays two roles in a modern capitalist economy, supplies the means of payment, and determines the capital development of the economy. Now, so what did he say about that? One of the first observations that comes next, these developments, same ones, suggest that the role in the economy of government organizations needs to be reviewed. That's what he said. The role of the government in the national economy needs to be reviewed. Now remember what I said. He was the staff to the Commission on Money and Credit. So he knows that the role of the government there was a significant discussion that took place. But here he's saying it needs to be reviewed. What does he say? Central banks broadly defined. I'm glad he said broadly defined, because we talk about it in terms of the monetary authority. It's the monetary authority. That's where we're going with how to change the money and banking system. So broadly defined central banks, if they're publicly, completely owned and controlled, same thing as the monetary authority, but it can be. To supervise, regulate, and examine banks, to control the growth of bank money, he wasn't saying not bank money, and to assure that the bank's liabilities function as a payment mechanism, as they're supposed to. Needs to be reviewed. Hyman Minsky in 1994 says the role of government needs to be reviewed. How? In general, the discourse in economic policy takes place on two planes. Again, I apologize, because all I'm doing is giving you guys some quotes from some people who study this issue. And Dr. Minsky, to me, is the extraordinary example. He says, in general, this discourse on economic policy takes place on two planes. I'm not saying anything about the first plane, it's the one you know. But the second plane is that of legislation that affects the structure and operations of banking and financial markets, and the government involvement in setting rules that constrain and contain banking and financial markets. That's the second plane of the discussion of economic policy. This paper concentrates on policy of the second legislating institutions and usage is plain. And so let's see what he has to say about it. Okay, Dr. Minsky, for those of you who don't know about Dr. Minsky, he's famous for his financial instability hypothesis. Okay, so I mean, I'm going to take a second just to say that. What is his financial instability hypothesis? It's basically what we would call the cyclicality of booms and busts. Okay, it's the financial instability hypothesis says in periods of financial instability we regulate and we do this and we do that, and then we get periods of financial stability out of that, and then we deregulate. And when we deregulate, we get more periods of financial instability. So his financial instability hypothesis was that the booms and busts are kind of natural outcomes of the system that we have for some reason. Okay, and he says, oh, okay, I'm not going to read that first part because he brings in the price of assets, and to me, everything is between the flows of incomes and the payment flows due to financial commitments, which are debts. Debts and incomes. That's what makes the financial economy work. If there's more of these than these, we end up where we are today. The debt overhang, the debt saturation, etc. He says these interactions reflect the essential characteristics of a capitalist economy, that is simultaneously an income generator and a financial system. The financial system being, again, what determines the capital development of the economy. He says these periods of apparent incoherent behavior occur as a natural outcome. He said that's why he was kind of infamous for his ability to stick with the financial instability hypothesis. It just kept happening. And if you studied history, it has been happening forever under the money and banking system that we have today. And the financial instability, again, these are his words from the paper. I really hope that everybody will read the paper, okay? Business cycles mainly result from interactions between payment commitments, debts. We cannot advance the economy right now, today. Today, we cannot advance the economy to tomorrow without more debt. And people got to get that, because debt is the driver of the prosperity that we achieve. So that part's okay, which arise in the process of financing investment and position of capital assets, and the flows of gross capital incomes. And this is where, again, he's back to being an economist, and I wouldn't be. I would say in the flows of incomes. Your household income is going to determine your ability to pay your debt. If you're a business, it's your business income. Income is going to determine your ability to pay your debts. And if you're a government, it's your government income that's going to allow you to pay your debts. So, business cycles are endogenous in capitalist economies. That's the financial stability hypothesis. And the theory that Keynes developed, upon which the financial stability hypothesis is built, money and finance are in general not neutral. This is key. Oftentimes you hear economists, especially monetary economists, say, well, money and banking are neutral. Money just goes to where people ask for it. And banking just provides it. In particular, changes in monetary and financial institutions will affect the economy. I thought I took that slide out, sorry. Again, how does he explain it? In our complex world, households, governments, and foreign governments and enterprises have outstanding debts. We all have debts. But incomes can be either more than sufficient, or insufficient to fulfill payment commitments made during the prior period, prior financing. We live in a world where we need to have debts in order to have progress, in order to improve our standard of living, and we may or we may not have the incomes that we need in order to pay those debts. Dr. Minsky is seeing that as a problem. Here, much of the economic history of the United States could be written in terms of attempts to get money right. And that's absolutely true. If you study economic history, you see that it is absolutely true. After a particular money banking and financial structure failed, that either politically or economically, new structures put in place, the history of reform and subsequent failure, followed by another round of reform, reflects the two not completely compatible requirements placed upon the monetary and banking system to provide a safe and sound medium of exchange and to furnish channels for the finance and capital development of the economy. I'm sorry that I'm making you sit here while I read that. There may very well be a mismatch between the structure of the Federal Reserve System and the manner in which it interacts with the economy. A mismatch. And he says the Federal Reserve System. I love that he says the Federal Reserve System, because it is the Federal Reserve System. You know, the fractional reserve banking system is how they create the money and how they create their assets, and the manner in which they interact with the economy. Why? Now all this really says is that in a big government under big government capitalism, and we sort of have big government capitalism. We do have that sort of. The government does deficit spend, has to deficit spend, and in doing so, that deficit spending contributes to the capital development of the economy. People could argue with me about that, and I'll be glad to, but that's a fact, you know. And so we say to ourselves, government deficits are the equivalent of investment in sustaining aggregate capital incomes. I have my own personal way of saying that I learned from my dad. My dad says, don't worry about deficit spending, worry about how you're going to finance the deficit spending. Because the deficit spending is merely a turn of what the V represents in the economic equation of money, which is monetary velocity. Okay, and if it's monetary velocity, then my dad said, how can it be bad? If you minus the V, then you have the M. And all government spending is a turn of velocity of the existing money supply. Again, that was my dad's thing. The policy posture. Now, this just says that you can't really, you can't squeeze your way out of this. You can't austerity your way out of this. You can't look to reduce the debt. When you have the debt, you can't look to reduce the debt. Why? Anybody? Not a trick question. Because when you reduce the debt, when a debt-based money system, you reduce the money. So you can't do that. Okay? You just can't do that. He says, by lowering the overall ratio of attained GDP to potential GDP. So in other words, you're leaving more potential GDP unattained by taking that posture, taking money out of the economy. So then he got into 100% money in the national banking, 100% money. So this goes to the Irving Fisher and the Henry Simons and the public money aspect of it, okay? Because this is where Minsky really went off, I want to say off the tracks, but off his traditional, way of looking at things. He opened up to this concept of 100% money or public money issuance. That's just his observation. We can have a banking system that holds interest-bearing reserves at the Federal Reserve equal to 100% of their deposits subject to check, and the Federal Reserve banks hold government bonds to offset their currency and bank reserve liabilities. That would give us a monetary system in which currency and deposits are fully equivalent in the assets by which they're offset on the books of commercial and Federal Reserve banks. The conditions for 100% money are satisfied. And it was Irving Fisher when he published his 100% book on 100% money. The purpose was to bring about a public money system. Okay, so right there he engaged it to that level. He says, thus as the 21st century is about to be ushered in, an idea which was on the table during the 30s discussion of reform can once again be on the table. It was 1994 when he wrote that. It's 2019 today, and that's my question. Shouldn't that public money system again be on the table? And how will we get it there? One virtue of the 100% money is that it separates the two functions of the monetary and banking system has to be reformed. perform. Remember the problem? Remember the problem at the beginning? He says, one virtue of the 100% money is that it separates those two functions. It puts money over here in the government sphere. Yes, in the government sphere. Excuse me. And banking over here where it belongs, in the private sphere. Provision of a safe and secure means of payment on capital. So, I'm sorry. All of that is in, but this is me. This is me. Institutional separation of the money creator issuers from the capital developers must be structurally and systemically accomplished as a public policy virtue. Well, I never thought I was going to find that in Hyman Minsky's paper. Now this is, okay, sorry about that. Now see, that's my skill level right there. But that's an article that I wrote for Global Economic Intersection. And I had written it, well before I read that other stuff. But the problem with money and banking is inseparability. That's how I wrote that. And I think Dr. Lewis sent you a link to that. Financial instability solved through monetary reform. Now this, again, 1994, okay? And we had this small 1989, 90, recession, and we came out of that, and then we were headed for the 1999 recession, and then we were headed for the 2008 recession. That's where we were headed. And how did we go there? And what came out of it? This is what he said. The progress to a small number of banks, each one which is too big to fail, with maximum credit lines so large that conditions of supplier credit to the large borrowers will improve relative to the condition of supplier credit to the small borrowers, which seems to be the most likely outcome of what is now taking place. Now that to me is a prescient observation. Seems to be the most likely outcome. It is the outcome. We're living with that outcome today. The banks are still getting bigger today. Okay? The banks are still getting bigger today. And where is it going to end? Where is it going to end? Seems to be the most likely outcome of what is now taking place. So he makes a proposal. Dr. Minsky makes a proposal at the end of this paper. It's 2 paragraphs long, the end of my talk. He says, the time has come to open a national inquiry into the structure of the banking and financial system. Get out. Much of what we now have may be obsolete. The sluggish economy of the past decades, combined with the apparent reluctance of the Federal Reserve to give full employment a chance, can mean that our financial structures are not consistent with the needs of a progressive democracy. Our banking and financial structures are not consistent with the needs of a progressive democracy. I say we should do something about it, and we can do something about it. And I agree with Dr. Minsky about how we should approach doing that something about it. Did I do that? No. Okay. In 1994, Dr. Minsky observed that finance capitalism itself, finance capitalism is what we have. We don't have a great, nice, open, beautiful, wonderful capitalist system that we used to have. We have financialized ourselves into finance capitalism, where it's strictly Ponzi capitalism. And he says that finance capitalism might not be consistent with the needs of a progressive democracy. Might not be. And this is the last part of it. He says, in the past, serious changes were the result of serious public inquiries. I suggest that enough is amiss in our financial and banking structures that it's time to go back to the drawing board. And there we go back to the public money proposals that he had mentioned earlier. I mean, by the way, there's 2 whole chapters in his paper, not chapters, parts, I should say, of his paper that deal with those money reforms of the 30s. And determine what monetary, financial, and financing arrangements should be in the 21st century. He closes, a late 20th century National Monetary Commission should be on the public policy agenda. And that is pretty much all in for reform. So that's it. That's it. He said, we'll never get to achieving what we can achieve. We'll never get to considering the monetary and financial arrangements and what they should be to fix the capitalist system, not to destroy it, but to fix it. Unless we can have a National Monetary Commission, which should be on the agenda. And he said that's pretty much all in for reform. So that's it. Thank you very much. That's the end of my talk. I hate to leave like that, but that's the end of it. And I hope that we have time for questions. Do we have time? Any time for
You
questions?
have 5 minutes left.
5?
5 minutes.
Sorry, I'm really sorry. I was hoping to get through that much quicker. So I definitely would like to hear what anybody thinks about anything, or anybody questions about anything, especially about anything that I said, because I was using some pretty strong language there with regard to monetary economics and stuff.
Any question, everybody? I got a simple question. Go ahead.
Okay, yeah, I had a question. So maybe this is me being like a basic economics student, but like you talked a lot about separating money and banking. So you're talking about separating like something that like creates money through loans and something that literally runs monetary policy, or like what do you really
Okay,
in like
great,
layman's
great,
terms?
great, great. Thank you very much, because really this is really what I want to talk about. Okay, I'm with the I'm with the Kettle Institute for Debt-Free Money. Okay, so yes, what you're saying is exactly right. Okay, and it should be noted that those two proposals that were on the board there, the Henry Simons proposal for the Chicago plan and the Irving Fisher proposal, these are the 100% money, but he did a publication in 1939, the 1939 Program for Monetary Reform, in which he collaborated with 5 other distinguished academic professors of economics, and wrote this paper and submitted it to the entire academic economic community in the country and the world, and asked everybody for their opinion about it. And it was all about public money. It was all about separating it. It was all about the government issuing the money. The government issuing the money rather than issuing the bonds. It's pretty much that. It's pretty much like that. The government, instead of issuing bonds and borrowing money from people that have it, the government would issue the money and spend it on things that are in the budget. Spend it on things that are in the budget. So that's the answer. Okay? That's how they would do it. And all of this is already sitting down in Washington, or up in Washington, I guess from here, is sitting up in Washington on a shelf somewhere, because Congressman Dennis Kucinich put all of those historical models, if you will, into a bill that would accomplish exactly this. And it talks all about how to set up the monetary authority and where their authority comes from, the Constitution, etc.
Follow-up, so don't you think by the government like taking control of that kind of that sector, that kind of the whole point of like the Federal Reserve was to like isolate it from political skepticism? So by the government kind of taking on that role, don't you think that they would feel like the political pressure a little bit?
Okay, good question, and you have to protect against that, okay? And yes, you're right about that. And they do have to protect against it, but all that means is that you really need to have an independent and autonomous monetary authority. And the only thing the monetary authority does is to determine the amount of money in the economy. That's the only thing they do. Besides from that, the government has a budget just like it has now. Only it's not going to have the debt to support the budget on the income side. Instead of having debt on the income side, what are they going to have? Who knows what they call that stuff that goes onto the income side of the budget if it's not debt and if it's not taxation? I'm sorry. I said to myself, I'm not going to ask any questions that, they call it seigniorage. That's what they call it, seigniorage. The gain between the issuance of the money and the cost of issuing the money. It's called seigniorage gain, okay? And so that side of the budget is going to say, well, actually they have what they call other sources of income, which seigniorage gain is under that, okay? And so that's how the money would come into spending. And the rest of it is all what's in the budget. Everything that's in the budget, whatever's in the budget can be spent. So the concern about the government is valid and has to be stayed a point, an important point. And but it's definitely doable. And by the way, so the system that kept the government from issuing the money is the system that got us where we are now. And maybe people think that the system that we've got now is great. But if you hear Dr. William White, it's falling apart at the seams. And we really need to do something new about it. Dr. Liu. Oh, I'm sorry.
Avery has a habit of asking questions that I want to ask. So,
Okay,
some
please.
minds are like,
So it's not clear to me that if the government were to issue high-powered money versus issuing bonds, that it would make very much difference. Seeing as the Fed pays IOR, so long as interest rates remain roughly constant, what I'm essentially saying is that money and bonds are perfect substitutes in the current system. Money pays about a 2.4% interest rate, and if they were to simply roll over like 3 months, 2 months, it would have roughly the same effect over time.
Okay,
So
okay, I'm fine.
So seeing as in a fiat money system, money is a liability of the government, and seigniorage really just comes from the fact that they can issue cash that they don't have to pay interest on in order to, maintain, they get revenue from not having to pay interest on that money. However, if they were to simply finance themselves entirely with money, they would be committing to a permanent zero interest rate policy.
Okay.
So what I'm saying is that having them finance their deficits with money that pays a 0% interest rate would mean committing to a permanent ZIRP, or zero interest rate policy.
Yeah, well, okay, but there's actually two things there, okay? One is the money, and then there's the relationship of, to the debt, okay? And to have debt, the cost of money, is determined in the free market today, okay? And to be honest with you, the cost of money would still be determined in the free market, okay? Because there's no reason to change that the free market would determine the cost of money. Like I said, we want banking to do banking, okay? And that's really where the cost of money is going to be determined. But the floor, and you're saying, well, now they do it with interest on reserves, and that's the floor, or the federal fund rate, that's the floor. No, there's going to be a zero floor. Yes, there's going to be a zero floor because the government's going to issue that money. But that money being in circulation, that money going into circulation is only part of the money and credit that's going to be in circulation, and all the credit that's going to be in circulation is going to be determined at value and cost by the banking industry.
What I'm saying is that if you have a floor at 0 and you're financing government deficits solely with high-powered money, you're going to be committing yourself to a permanent zero interest rate policy. Without raising that floor, interest rates will, at least money market rates, will remain at 0.
Yeah.
And I'm saying that could create problems with inflation. And,
Well, how so?
Mhm.
How so?
Mhm. Well, I mean, if you need higher deficits or something, then you have no way to counteract that with monetary policy.
Monetary policy, it's a big, okay, it's a really good question. It's a really good question, but it's actually very answerable,
Mhm.
okay? Especially I invite you to think your way through it and to read your way through it. Because inflation, there isn't anything in anything that I said that would lead to there being more money than there is goods for sale. That's the only thing that can cause inflation, okay? And so there's nothing there. There isn't anything there. Inflation is the fear. But you said something earlier that if it's okay, I want to go back to, you said that they're the equivalents. You said issuing money and having seniors gain is the equivalent of issuing debt and having a like 0% money policy.
sorry to interrupt for a second.
Sorry.
Class time is up, so if people need to go and go to next class, so feel free to leave quietly. And for those who want to stay and ask a couple more questions, you have another 3-4 minutes.
Yeah, one of the things that I do in my real life as a Kettle Institute director is I encounter modern monetary theory, and I don't know if you guys are familiar with modern monetary theory, but they always say that. They always say, in fact, I was at a Levy Institute conference where Dr. Stephanie Kelton, who was one of their leading economists, was there, and she was postulating Lerner's functional finance, and Lerner says in his functional finance writings, he says the government can either issue bonds or print money, okay. And so at the break, at the question, I said to them, well, I don't understand. If you can do either, why don't you print the money? And she answered, and her and Dr. Scott Fulwell answered, well, they're equivalent. Okay, that's what they said. Well, they're equivalent, And I said, well, I don't know, functionally they're equivalent, okay? And I said, well, I don't know really what functionally equivalent means. I think it's one of those terms where it's beauty in the eye of the beholder kind of a thing. Because to me, you just said that we can't advance the economy because people don't want us to have any more public borrowing. That was part of her talk, okay? And yet you're saying that these functionally equivalent things, which includes printing the money, is not something that we should do. Because I said, Bernie Sanders, and I'm a Vermonter, you know, I said Bernie Sanders would go for printing the money much more than he would for borrowing it from the bankers, okay? That's what I said. But this is a much bigger point, functional equivalence, okay? Public debt of the United States of America today, because we do not have government issuing the money, is $22 trillion. $22 trillion, and it's grown on a curve like that, okay? If the government issued the money, we'd have exactly the same kind of economy because we would issue the same amount. There's no reason to think that the government would issue a different amount, except if it got the approval of Congress. If the government had instead issued the money, we would have $22 trillion in equity. And that's, by the way, the subject, what I wrote about in that paper there, okay? We would have $22 trillion in equity and no debt, versus having $22 trillion in debt and obviously no equity. And if we do the math, at least the way I do the math, it's $44 trillion difference. We the people are $44 trillion poorer. We are been denied having $22 trillion in the bank, and instead we have $22 trillion owing the bank. And so to me, that's not functional equivalence. That's functional equivalence from the banker's perspective, but to me, not from mine, from the public's.
Well, there's just a small note. If you read the fine print on the Treasury's website,
I do.
Money is considered a liability of the government.
So?
If you combine the balance sheets.
So,
So what I'm saying is that you are not issuing equity when you gain seniorage. You are issuing a liability. And if
you and I can have a conversation about that, okay?
well, that's just how. If you look at the Federal Reserve's balance sheet, right? And
Federal Reserve's balance sheet or the Treasury's? You said the Treasury's.
Well, I mean, the Treasury considers the Federal.
I'm sorry. Right.
Well, no.
Right.
Combine the institutions if you want in your
I
mind.
do. I definitely define
Right.
the institutions separately. One's private and issues debt, and one's public and issues money.
But it does something after the government. Anyway, if you look at the Federal Reserve's balance sheet, on the liability side, you see.
I don't look at the Federal Reserve's balance sheet. I look at the Treasury's balance sheet.
Yes, but what I'm saying is, in the end, it nets out because if you want to issue bonds at a 0% interest rate, which you can do, that's going to be more or less equivalent to issuing money at a 0% interest rate, as long as you can roll over in the future.
Okay, so what you're saying is a system of permanent increasing debt to the public is equivalent because the Federal Reserve says so. I'm sorry,
Well,
that I don't agree with.
Think about if you take out a loan at 0% interest rate, and then you can refinance at a 0% interest rate into perpetuity. Because that's what's happening if the Fed
You
is
pay the interest in perpetuity, compounding interest in perpetuity.
Well, yeah, but it's 0%. If you have a 0% interest rate on a loan or a bond, which it is in many cases, you can have zero down for a long time, and if you refinance that continuously, then you will never be paying $1 of interest because you refinance your principal, right?
All right, guys, let's thank our speaker once again before they keep on jumping another 2 hours.